This series is supported by Apollo Global Management, a leading provider of alternative asset management and retirement services solutions. Apollo seeks to provide clients excess return at every point along the risk-reward spectrum and is focused on empowering retirees, building and financing stronger businesses, and driving a more sustainable future.
Because we're a debt investor, I'm actually focused on the downside because in our returns, we do have upside mechanism, but it's generally fixed exit fees. So we're not looking at the home runs on the equity side. So I always tell them, okay, it's great news if you're going to knock this out of the park and you're going to sell to whoever, et cetera, et cetera. But really, I'm interested about the survival of the company, that you will continue to exist. And so for them, I always tell them, focus on the bad news to me. The good news you can tell me at the end, but the bad news is what I want to hear, because ultimately, if we hear the bad news, we can work out what are the potential solutions. There might not always be a solution, but at least we can work it out. So as a debt investor, I probably have a different focus than an equity investor. For me, it's protecting the downside rather than looking at the upside.
I'm Aoife Devitt, and welcome to the 50 Faces podcast, a podcast committed to revealing the richness and diversity of the world of investment by focusing on its people and their stories. I'm joined today by Shane Lanigan, who is portfolio manager at Beachpoint Capital Ireland, a role he has held since September 2018. He was previously a director at BSM Finance, a senior debt provider to entrepreneur-owned VC or PE-backed businesses. Welcome, Shane. Thanks for joining me today.
Thanks a million for having me, Aoife.
Well, let's start off by talking about your background. Can you walk us through where you were born, where you grew up, and how you entered into the world of investing?
So I was born and brought up in Kilkenny, so we're obviously hurling mad. I always, though, wanted to work in the investment sphere. And so I went straight to college, UCD, did a Bachelor of Commerce, I then did a Master's of Finance, and I went straight to London. I don't know why I'd always wanted to work in London. I always felt that if you were going to work in the world of finance, you should try and get to London or New York. And London was where, I guess, the call was easier for me. So I started as a graduate trainee with an insurance company working as a credit underwriter. And then after a couple of years, I moved to a Japanese bank, the Fuji Bank, now Mizuho. And there I worked as a credit analyst. And even though we were in London, we were operating effectively as part of the head office. And we were sanctioning Fuji's investments, principally in leverage finance, so management buyouts of UK and European businesses. I worked there for 4 or 5 years, trained up on the credit side, and then I moved into a front office role with Erste Bank, Austrian bank, working in their acquisition finance team. And that was essentially focusing on lower mid-market management buyout deals. So really working on the buy side, deal transaction size about 50 million, where you would work with 2 or 3 other participants. That was about the start of when CLOs started to enter into the European market. And as the deal size got bigger, you saw more institutional investors coming into the market. And so I was approached to join a fund which was managing CLOs. And I joined Elgin Capital in the early 2000s, and I was a portfolio manager on 5 CLOs there. So that was my kind of first taste on the investment side away from the banks. I decided, I took the relatively insane decision that I wanted to do something different, 2008, just before credit crisis hit. And I'd been approached to join BSM Finance, which is a small niche investment manager at the time. They were effectively doing venture debt into entrepreneur-owner managed businesses. So I was going away from doing large PE-backed transactions into much smaller deals, investment tickets of 2 to 3 million, but you were getting much closer to the management team and to understand the business, etc. I was there, and I guess one of the things that did surprise me, I thought I was going to end my career there. I worked there for 10 years. It was really enjoyable. I liked the team I was working with. We were a small team. But then we went out fundraising. We had launched a fund in the UK, we'd launched a fund in Ireland. And the fund in Ireland was meant to be a 10-year fund, but we had effectively invested all the capital within about 8 and 9 months. So we needed to go out and try and raise more capital. I met up with Beach Point. And Beach Point are a 15 billion credit fund based out of Santa Monica. Essentially, they looked at investing in the Irish fund I ran, and I went out for dinner with a number of the senior people at Beach Point. And as I ordered my starter, I realized this wasn't a dinner, this was actually a job interview. And so essentially, myself and the guys at Beach Point spoke the same language. We spoke about credit, we spoke about having covenants, having protection, about the importance of management teams, etc. And by the end of the dinner, they had said, right, we'll still invest in your fund, but we'd actually prefer if you came and worked for us and ran money for us. And so that was about 2017. I actually ended up joining Beach Point in September 2018. So always on the buy side, always in credit, but a bit of a meandering journey.
Well, we'll certainly go back to that job move right on the heels or right before the financial crisis and talk us through that, because that will take us, I think, into the present day. But very quickly, hurling mad, player, coach, observer, where's the hurling passion?
So I played as a kid, played for my school, played for my club. So I'd have been okay, nothing special. Then when I moved to London, I gave up hurling. But hurling and the GA always draws you back in. And so I've got he's a 9-year-old now. At the time we moved back to Ireland, he was 4. Because the people in my local hurling club knew me, they dragged me into first, bring my son along. Then suddenly I was coaching the under 6s and under 7s. Then I was the COVID officer. And suddenly I didn't know how I'd get away from them. Sadly, my 6-year-old decided, he came up to me and said, Daddy, I know you love hurling, but I've decided to retire, and walked away. So I still am involved, help out where I can, and it is, it's one of my loves in life, but there's not really any active involvement anymore.
Well, the whole GAA is so much part of the fabric of Ireland and communities, and continue to be that way through COVID. So thank you for your service in that respect. Moving now just to go back to a little bit the move when you moved to Beach Point. Did Beach Point have the similar deal size that you had been doing, or did you start moving up the spectrum then?
So when I moved to Beach Point, essentially the funds that I'm running at Beach Point were doing the same thing as I was doing previously. So whereas Beach Point in the US and in Europe are doing much larger deals, they will be doing deals kind of 40, 50 million on the direct lending side, but they're also involved in, throughout the credit spectrum. What I do would probably be described by Beach Point as closer to micro lending, because the ticket sizes that we're investing in is still, average ticket on entry is about 2 million. Average ticket, because we like following our money, is about 4 million, which is much smaller than what Beach Point would look at. However, one of the things that I've brought to Beach Point is we have been doing some larger deals where, because we're investing in the funds that I manage in earlier stage businesses than Beach Point would generally see, but these businesses are high growth, high margin potential. They become cash hungry, they become capital hungry. And so there's been a number of deals where we've known the management team for years, we've known the business, and we've been able to bring it into the broader Beach Point funds. However, my focus is mainly on the smaller deal size.
Well, having done this for many years and essentially most of your career, what would you say are any of your kind of core beliefs when it comes to this business? What are you looking for? What's a red flag when you see it? What do you think are the secrets to success in direct lending?
So for us, because we focus on entrepreneur-owned businesses, owner-managed businesses, it's all about the management team, because these are small businesses that we only have to look at how many macro shocks, people talk about black swan events, but we've had so many black swan events between COVID, the dot-com credit crisis. There's been 3 in the last kind of 20 years. It's all about picking exceptional management teams, because small businesses are going to face macro shocks. And then it is all about the management team guiding that business through those problems. Now, what I tend to find is we're generally back in seasoned entrepreneurs. So I've got a face for radio, as they say. I'm old and bald. a lot of the guys I'm backing are basically of a similar profile in terms of age. Our ladies, we've backed a number of female entrepreneurs. And what I actually love to see is entrepreneurs who've had a failure in the past. Because I think in my investment experience and what I see from the entrepreneurs I'm backing, you learn far more when you lose money than you do when you make money. You can be lucky and make money, but when you lose money, you start to reflect and you go, why did I make that decision? Hindsight is easy, but what were the things that I should have considered when I made the investment? And the investment went on that journey and ended up where it was. And so absolutely critical is the management team. Second is that there is a reason for this business to survive, that we want to be backing businesses that are going to be here long term, that we generally avoid kind of looking at things which are cyclical, which are fad. We want to ensure that there's a longevity to the business. So management teams, and that there is something in this business, that there is a reason that someone will want it to survive.
One of the things that, because I hear this time and time again on the podcast, it's all about the people and clearly seasoning and experience. And you mentioned macro shocks being a fact of life for small business, for any business. It does seem they're coming fast and furious, and that there's no playbook for some of these macro factors and the shifting consumer demand and shifting interest rate environment. So obviously these entrepreneurs aren't getting it right every time, but how do you check in with them in terms of their taking the temperature and just watch them navigate unprecedented times?
So we take board observer rights on every investment we make. We get monthly management accounts. And one of the things we do is that we ensure that there's a dialogue, because when I meet a management team, the one thing I always say to them at the start is, I don't mind bad news, but I don't like surprises. Because ultimately, if you know that there's a problem and you've got time to fix it, or at least try and fix it, then that's fine, because we're going to make mistakes on the investment side. But if we don't have time to deal with it, so what I always say is no surprises on the business journey. Now, from one thing I also would say is sometimes you have to have empathy, because with the entrepreneurs that we're dealing with, whilst we all want to make money as investors, the businesses that they're running, that's their baby. That's their blood, sweat and tears. And so we find it, especially in Ireland, entrepreneurs are very reluctant to give up equity. I think they'd often give up equity quicker than they give up their firstborn. And so what you have to understand is that whilst we might be kind of troubled over the performance of a bit of their business, it's nothing like what they're experiencing. And so you need to navigate that. There's times when you need to put your arm around someone and go, look, we're here, we're going to support you. And then there's times when you might have to hit them a belt to get them in the right place.
And it's interesting, just the last point on this, you mentioned not wanting surprises and letting them know that up front. One of the things I feel I often need to say is I don't want spin. Yeah. I don't necessarily want the sales positivity today. I'd like to hear about every red flag, everything that keeps you up at night. In a way, you've already bought the spin if you're there as an investor. How do you get them to no longer spin?
So what I always tell them is, because we're a debt investor, I'm actually focused on the downside, because in our returns, we do have upside mechanism, but it's generally fixed exit fees. So we're not looking at the home runs on the equity side. So I always tell them, okay, it's great news if you're going to knock this out of the park and you're going to sell to whoever, et cetera, et cetera. But really, I'm interested about the survival of the company, that you will continue to exist. And so for them, I always tell them, focus on the bad news to me. The good news you can tell me at the end, but the bad news is what I want to hear, because ultimately, if we hear the bad news, we can work out what are the potential solutions. There might not always be a solution, but at least we can work it out. So as a debt investor, I probably have a different focus than an equity investor. For me, it's protecting the downside rather than looking at the upside.
Well, it's good to know that you can get that then by making it clear what you're looking for. Let's talk a little bit about the geography you're focused on. We're sitting here in Dublin, in Ireland, a live interview. This is a real treat. But Ireland is one, but you're also looking elsewhere. Can you talk about maybe first Ireland and why you would look elsewhere as well? What's driving that?
Sure. So we've got 2 funds in Ireland. The first fund was launched in 2018, and it was a 2-year investment period and is now in its harvest period. It was hit by COVID because I think like all of us, when COVID and the lockdowns initially happened, we were a bit rabbits in a headlight going, okay, what are we going to do? How's this going to impact our companies, especially because we're investing in small companies? So we essentially, during kind of a part of the investment period, we just focused on the portfolio. Fortunately, the portfolio did okay during that period. We then launched a second Irish fund, which was still in its investment period, and that has an investment period for another just on 12 months. And the opportunity in Ireland was principally the banks, after the credit crisis had stepped away, a number of the entrants to the market had basically exited. And there weren't as many alternative lenders in Ireland as you would see in other markets. And so there was a significant lack of competition. And unfortunately, there still is. One of the things I do love is other alternative lenders coming into the market, because they educate the market as a whole. And actually, being an alternative lender, people are more willing to start talking to you than in Ireland. A lot of it is down with relationships and trust, and they will just go to the bank and that is it. So there was always a great opportunity in Ireland. We then, though, I had been my previous house operating in the UK. There was always a market, because on the direct lending side, there's a lot of direct lenders who focus on private equity backed or VC backed businesses. But because of our heritage, we had always focused on entrepreneur, owner managed businesses. And we could see that there was still a gap in the market. So Beachpoint, we entered into the UK market in mid 2022. And so we've got a fund over there doing effectively the same thing as we're doing in Ireland, which is senior debt, but at mezzanine type interest rates, to either high growth, high margin tech businesses, or else we're focusing on more mature, stable businesses, profitable EBITDA, and doing buy and builds or acquisition finance or sponsorless MBOs in that market. Now, what we found in the UK recently is there actually is an opportunity that I haven't seen before. So I would say that if I look back to the credit crisis times when I was operating in BSM Finance, we are now seeing more opportunities in the direct lending market than we were then, because I'm trying to figure it out. And I think there's a couple of reasons. Firstly, the banks gave a load of loans to small businesses under the CBILS, which was a government COVID support loan. And that had two impacts. First, the banks' P&Ls, because they were 80% guaranteed by the government, the banks basically filled their boots with those type loans. Secondly, small businesses who might have been wary of debt became addicted to the drug of debt. And so became much more used to actually, I will take on debt to grow the business. You now have the COBIL support, the CBIL support being withdrawn from the market, and the banks don't have the capacity to actually lend further. So what we're seeing is a huge opportunity especially in the regions where there is not as many other alternative lenders operating. And so I think the opportunity set at the moment is greater now than it was credit crisis. There's a banking stroke a lending crisis, I think, in the UK, in the small to medium sized businesses. If you're a company and you're looking to borrow 10 million plus, there are plenty of opportunities. There are plenty of mainstream funders. There are plenty of alternative lenders. In the space we're operating, it is relatively tough to find alternatives, to find competition. So it's great for us because it allows us to lend to businesses that we probably, in all honesty, shouldn't be lending to. And it gives us, better risk returns, but it's not great for the companies. And so I'd say the market in the UK, the opportunity we saw there was in the owner-managed sector is really strong at the moment. How long that will last, I don't know, but it's certainly going to last for the next couple of years because we don't see enough liquidity coming into that part of the market.
Well, I suppose the natural follow-on question then is this part of the market, the sub £10 million borrowers, how exposed are they, I suppose, to this recession that is yet to bite us? Thinking about some of even the small cap stocks, how much they've underperformed, the pressures of scale, not having scale, the pressures of more barriers to entry, more regulation. And you have experienced a downturn before. You know what a downturn looks like in the segment. Where do you think we are in terms of that cycle?
So firstly, if I look at our own portfolio, we've always tried to invest in companies where there's contracted revenue, where they're not exposed to the kind of cyclical side of the economy. And we've gone heavy on defensive industries, education, etc., which have proved us kind of well in the past. And so the portfolio in the UK, touch wood, is actually performing relatively well. But then when I see, because we see opportunities in every sector, when I see some of the trading figures, I get very nervous. And especially, we would be very reluctant to do retail sector. And when I see the numbers in the retail sector, it is tough out there. And so I think we're in for a fairly rough time. Ironically, I don't at the moment see the problems in the Irish economy. The Irish economy continues to be really strong. There are some things in the horizon that make me slightly nervous. UK definitely it's further down the problematic path. But if you focus, there's enough small businesses out there in sectors that are cyclical and defensive. That's where we're focusing on.
We're going to take a short break to hear from the supporter of this series, Apollo Global Management. I sat down with Joe Moran, Managing Director, Institutional RIA Sales at Apollo. I asked Joe what opportunities Apollo was seeing in the private wealth segment.
So Apollo is developing a product suite that solves fundamental retirement and investment needs and is tailored specifically for the individual. Individual investors remain significantly underweight alternatives relative to institutions, and Apollo is committed to being an innovator in the industry, applying the firm's more than 30 years of problem solving for the world's largest institutions to the wealth channel.
And now back to the show. And how about some of the kind of popular private equity darlings, say the dental office roll-ups or other ventures that, we've seen them look at the fitness sector. That's almost a bit similar to retail. The boutique fitness hasn't done as well. We see the dental office roll-up, costs been taken out there. Where do you think, are there other sectors that you would be less confident about? So
we've seen a lot of, and it's not quite roll-ups, but workouts in the restaurant space, the hospitality space. Seems to be a lot of problems there. I lived in London for 28 years. If I walk down the main street in Islington, I look at all the shops that are empty. That frightens me. But then I look at some of the roll-ups. I can understand why the roll-ups are happening, but I'm scratching my head at the valuations. People are paying 15, 16x EBITDA for businesses they're good, stable, businesses. But I'm struggling in the current interest rate environment with the leverage that would be put in, how you're going to make money in those sectors. Is it a quick M&A arb on the multiples and that people are getting in and out? I don't know. Now, we actually ironically do a lot of buy and builds. We've done probably about 10 between now and the UK. And a lot of it is M&A arb, where we're backing a business that has strong EBITDA. It's picking up much smaller mom and pop shops and it's picking them up for a much smaller multiple. But what we've seen with the entrepreneurs in those instances, they're flipping them very quickly. And a lot of entrepreneurs are the one thing I think, for entrepreneurs generally are good buyers, but bad sellers. The best entrepreneurs are the guys who know to sell and when to sell. And there's a lot of deals and transactions happening where I just can't figure out the multiples and how anyone will figure out. Insurance broking side in Ireland, we had a huge rollout of acquisitions in that sector to a point where I'm not sure you can make money in the sector as a whole. We're actually backing a number of fresh buy and builds, and we're buying at low multiples, but I can see the multiples creeping in terms of the value that we need to keep an eye on.
Well, that's a really interesting segue into maybe the ESG risk question, because regardless of what name we call it now, I know from an allocator standpoint, every allocator will have their RAG rating for a manager, but they'll also have a RAG rating regarding that manager's ESG credentials and how much they look both at their own level and then at the underlying portfolio company. And let's take the example of daycare, because I don't think it's a million miles from elder care in terms of the potential reputation damage. And I see the strains in daycare perhaps around the difficulty of retaining staff.
Yep.
the increased costs, which are becoming unbearable for working families, and the lack of subsidies perhaps coming to that, and just that we see creches closing, even though there's clearly a huge amount of demand. How do you cope with that angle?
So I'll come back to the ESG and the reputational issue, but if I address we're seeing creches close, so what we've seen is it's all about the management. And so it is about people who can manage effective teams. So some of the best people that have walked through this door are some of the female entrepreneurs who are running the creche businesses. And this goes back to empathy. And I think that they are able to show one of the key metrics that we look at on the creche side is retention of staff, because retention of staff is critical in that business. And so that is something that we focus on, because if we look at the creches that fail, it is the staff retention, which you can just see there's a churn there continuously. On the ESG side, so I think it's quite difficult for small businesses because, so as an investor, we are being asked always about our ESG, both as at the fund manager, etc. And we have our ESG policies and guidelines, and Beach Point's strong supporter on that front. But when you then go to a company, and some of the companies we ask, okay, can you fill out ESG? They've probably never actually addressed an ESG form in their life. It's something completely new to them, even though subconsciously they're probably doing a lot of the things underneath it. So I think ESG for investing on the small business side is probably a bit more problematic, because these companies don't have, unfortunately, the resource to deal with that. Now, reputational side, it is one of the things that we are obsessed with, is basically the reputation of both Beach Point, both on behalf of ourselves and our investors. We've got the Irish government through the Ireland Strategic Investment Fund, who've been a fantastic supporter of us. And we've got British Business Investments, who, again, similar UK, again, great supporter of us. One of the things we have as a kind of mantra is that we are not going to embarrass our investors. We are not going to make an investment decision which will have an impact on them. And that brings us into the ESG side. So reputationally, daycare can be tough. We've seen some of the stories in the Irish press. Going back to the creches we manage, one of the things we are always looking at is the reports from the regulatory bodies, the supervisors on both the management, the care facilities, etc. And we want to make sure that they're absolutely top class. But it's a difficult one.
And well, let's move to some personal reflections now. So clearly, decades in the business, many cycles, seen some ups and downs. And we spoke about how you focus on the downside, and that's what you want from your entrepreneurs. So I'm going to ask you to focus on the downside briefly. Were there any mistakes, setbacks, challenges that you learned lessons from that you can share?
So plenty of mistakes. We'd probably be having to do about 5 podcasts if I told you all my mistakes. So one of the things I have is, so when an investment goes wrong, you always try and reflect. And one of the things I have in my office back home in Kilkenny is there is a games machine. And there was a company we made an investment in, great entrepreneur, just didn't work out. And I'd probably been hesitant on making that investment. I probably should have gone with my gut and not made it, but we did, and so be it. But I've now got a games machine. Whenever I'm thinking twice about investment, I turn around and look at it and think, right, what should I do here? Should I go with the gut feel? In terms of kind of mistakes, I wish I'd made the move into what I'm doing now earlier. So it's a cliche, but I really love what I do. I couldn't really pick a nicer firm to work with in terms of the people, the investment style. I've got a great team. I wish I'd moved onto the investment side earlier rather than staying in the banking side. From investment decisions, don't try and go into areas that you don't know about, thinking that you know better. So I have a pathological hatred to consumer businesses because it was my first loss. And it's just ingrained in me. Avoid that sector. Even though a lot of people can make a lot of money out of it, I struggle on that sector.
And we've spoken a lot about people management, credibility here, and tenure, really, and experience in the field. Were there any people throughout your career that had a particular impression that maybe acted as mentors to you or that were role models that you looked to?
Yeah. So one of the people, and you'd probably be really embarrassed about me saying this, is a guy who actually I've brought to work with me here at Beach Point on an advisory basis. He's part of our investment committee, and that is David Wilson, who I'd known David in the leverage finance market for a number of years. We'd meet on large deals, out on site visits. We'd meet in kind of social occasions. And he approached me to work with him as a portfolio manager on the CLO side. And I don't think I've ever learned as much from anyone in my career as him. One of the sharpest brains in credit, but also very funny. And always as well willing to look at how you can get a deal done in terms of structuring something. So whilst a lot of people will look at a deal and it'll be a black and white, with David, there is always a bit of grey there to work out, can you actually structure something to get a deal done right? And then the other aspect of him was that he was always great at educating people in terms of, on the investment side, talking about, he was very upfront. He's a very blunt Yorkshire man. And he was always very open about the mistakes he would have made in his career in terms of investments, etc., in helping you learn on that basis. And so definitely David. Second one, if I may, former colleague at BMS, Ewan Stradling, extremely intelligent. He was the one who really taught me about empathy investing, about there's times to hug people, there's times when you don't know how difficult this is for them when their business is failing, and that to get the best result for everyone, and both kind of on a personal level and a professional level, you needed to look after people at times. So they'd be the two I think about. Aside from that, family and friends. You know, being Irish, I've got 3 brothers, 2 sisters. My parents are still alive. We still have great chats with them. They would have always been a big influence in my life.
That's great. Well, certainly the Irish family, as Christmas approaches, warm memories there. But it's really interesting what you say about the empathy piece and about the need for that. I had another conversation with a VC entrepreneur turned microbrewery entrepreneur. He used to brew beer in the evenings and turned it into a business. And his advice was to always leave something on the table.
Yeah.
And I think that kind of initially surprised me, but I think ultimately that's the human factor.
Yes. Yeah. It's a good lesson.
Final question is around any creed or motto that you let guide you through life, or any words of wisdom you would maybe have for your younger self.
So I think it's a cliche, but treat people like the way you would want to be treated. And so when you're in a difficult decision, try and get the best result for both people, but think about the other person on the side of the table. It doesn't have to be a win-lose situation. That's my motto.
Well, thank you so much, Shane. It's been a pleasure to meet you here in person and to, I think, really put a human gloss on what's called shadow banking, perhaps as a misnomer, but on the world of private credit. I think you've taken it out of the shadows here for us. And thank you so much for coming and sharing your insights.
Thanks very much for having me.
I'm Aoife Devitt. Thank you for listening to the 50 Faces podcast. If you liked what you heard and would like to tune in to hear from more investors and their personal journeys, please subscribe on Apple Podcasts or wherever you get your podcasts.
This podcast is for informational purposes only and should not be construed as investment advice, and all views are personal and should not be attributed to the organisations and affiliations of the host or any guest.